Australia's property dream used to fit on a bumper sticker. Get a job, save a deposit, and buy a house to build your wealth. For 2 generations, that was a deal, and it worked so reliably that people stopped treating it like a dream and started treating it like a birthright. But right now, as I'm recording this, something isn't right. It now takes 11.2 years to save a deposit. A brand new mortgage eats nearly half of a median household's income. Rent under a new lease is chewing up a record share of what people earn. And here's the data point that breaks the entire model. Home values in Sydney and Melbourne are actually falling right now in the middle of 2026, and it's still getting harder for first home buyers. Bit puzzling right now. Prices are dropping and the door is closing anyway. So the question is no longer whether property goes up or down next month. The question is whether the old Australian dream still exists for anyone who doesn't already own, inherit, or get help from mum and dad. Because the data suggests something uncomfortable. Australia hasn't killed the property dream. It's made it hereditary. Stick with me because by the end of this, you'll understand exactly why the maths stopped working and who got locked on the wrong side of the trade. Let's start with what the dream actually was, because it was never just about shelter. Your house was your retirement plan. It was your inflation hedge. It was a forced savings account where you were legally obligated to keep paying into. For most Australians, the family home represented their entire net worth. And the beauty of it was it looked open to everyone. You didn't need to be rich. You needed a job, a bit of discipline, and time. But a wealth machine only works if the next generation can still climb aboard, and that's exactly what's stopped happening. Look at home ownership at the same stage of life, ages 25 to 39. Baby boomers at that age, 66% owned homes. Gen X at that age, only 62%. Millennials at that age, 55%. Now, 66 down to 55 might not sound dramatic, but watch what happens when you zoom into the youngest end. Some analysts suggest Australians born between 1947 and 1951 had reached around 54% home ownership by their late 20s. Those born between 1992 and 1996 had reached just 36%. That's an 18 percentage point collapse in a single stage of life. The hardest data we have confirms this is a permanent generational break, and it gets sharper. Boomers at that age were 3 times more likely to own their own home outright than millennials are today. So even the millennials who did get in are carrying debt their grandparents never dreamed of. Even those who managed to buy are now carrying unprecedented debt burdens, and most likely with less desirable properties like apartments in huge towers compared to what our parents and grandparents had. Basically a house on 600 to 800 square meters of land. So the obvious question is why? And the answer starts with the thing that stands between you and that deposit: rent. Here's the old advice, the advice every parent gave every kid: rent somewhere cheap, save aggressively, then buy. That advice assumed one thing, that rent was temporary, manageable cost on the way to ownership, basically like a waiting room. But look at what renting costs now. The share of median household income needed to pay rent on a new lease has hit an all-time high of around 33%. It's basically a third of your income going to rent. The share of renters in outright rental stress, paying more than 30% of their income just to keep a roof over their head, has climbed to 29.5%. That's a record. That's for stressed rentals at this point in time. And the vacancy rate, that's 1%. 1% means renters have almost zero bargaining power. And of course, rents keep going up. Renters are forced into fierce competition for every available property. Now put those pieces together, because this is the trap. Rent is now so expensive that it destroys your ability to save. But you're saving for a deposit that takes 11.2 years to accumulate, up from around 9 years a decade or so ago. And even if you get there, servicing a new mortgage costs around 46% of median household income against the long run average of just 34%. This is what we saw coming in the first half in the real estate cycle, and what we warned about prior to the money printing of 2020 and 2021, which didn't help renters either. So every side of the equation moved against you or the renter at once. Higher rents slows your savings rate, while larger deposit requirements extend the timeline to obviously get there to home ownership. By the time you finally buy, the mortgage itself costs far more. Rent used to be the waiting room before ownership. For a huge number of people, rent has become the trapdoor underneath it. And when you understand that trap, you understand why the escape hatch has become so important. Because there is an escape hatch. It's just not available to everyone, but we'll get there. I'll show you where. At this point, your family background matters far more than your salary. Ask yourself these questions. Did your parents buy early, back when prices were sane? Can they help with your deposit? Can you live at home rent-free while you save? Can you buy with a partner and double the income? Can your family co-sign or back your loan? Because the answers to those questions now matter more than a salary. Around 40% of first home buyers have received financial help from family since 2020. The bank of mum and dad has become one of the biggest mortgage lenders in the country. And 42% of millennials are living with their parents, many of them explicitly to save for a deposit. Think about what that actually means. Australia is no longer divided between rich and poor, but between those who receive family help and those who don't. If your family can help, the dream is merely delayed. If your family can't, the dream may disappear completely. But I'll get to a slight solution later in the video. I don't want it to be completely depressing here. Two people, same job, same salary, and obviously the same discipline. One has parents who bought a house in 1995 and the other doesn't. And that single fact, decided before either of them was born, now determines whether they'll ever own a home or just make things a lot more difficult. That's the mutation at the heart of all this. Home ownership in Australia has effectively been privatized inside families. Let's hope that actually builds families even stronger than what we've seen recently, but let's get back to it. Now, we do have to talk about all of this in the next piece, even if this is always a part of the debate that gets ugly fast. Migration. Here's the situation plainly. In the year to December 2025, Australia's population hit 27.8 million. It grew by 412,000 people in a single year. Of that, 301,000 came from net overseas migration. So just 111,000 came from natural increase. That's births minus deaths. So more than 7 in 10 of the new Australians last year arrived from overseas, 3 in 10 from here alone. And this is the moment where the whole conversation usually goes off rails, because migration becomes the easiest thing in the world to blame. But I want you to hold two ideas at once because both are true. Idea one is migration is not the villain here. And idea two, it absolutely matters because every new household needs somewhere to live. Let me give you the numbers around what everyone's arguing about. As of June 2025, the Indian-born population in Australia reached 971,000 people. That officially overtook the English-born population to become Australia's single largest overseas-born group. That number roughly doubled in a decade. And I know exactly what the lazy version of this video goes next. But here's why blaming one nationality misses the entire point. Nearly 70% of Indian-born arrivals hold a university degree or higher. The largest migration group in New South Wales is China-born. In Queensland, it's New Zealand-born. This was never a one-country story. The bigger truth is this: Australia's overseas-born share of population just hit 32%. That's the highest level since 1891. The migration numbers thrown around in political fights are often inflated by using the wrong measure, overstating the real figure by as much as 60%. Net overseas migration has actually fallen 2 years in a row from a peak of 538,000 down to 301,000, with Treasury forecasting it to keep dropping toward 225,000. Even as migration cools, the housing system still cannot keep up with demand, at least not for now, which tells you the bottleneck was never really the people arriving. The bottleneck is that homes that weren't built at the right time. And as migration falls, it's exposing the problem. Migration, too fast, too soon. Migration simply acts as a stress test that exposes the failures of the housing policy. And right now, that test is being failed by a spectacular margin. And when the market fails this bad for this long, politics doesn't stay calm. We're obviously seeing that now, lots of upheaval for both sides of the equation. It starts reaching for tools it once considered unthinkable. Here's a rule of thumb for reading any crisis. Watch what the politicians are suddenly willing to do that they refused to do 5 years ago. Because for decades, serious rent controls in Australia were treated as economic hearsay. Now, they're law. In New South Wales, no grounds evictions have been banned. Rent increases now capped at once every 12 months within 60 days notice. These policies have moved from fringe political demands to active legislation. The ACT caps rent increases at 110% of local rental inflation. Victoria now makes inflation a mandatory factor when deciding if a rent hike is excessive. The industry warned that capping rents would trigger an investor exodus. Instead, reports indicate New South Wales investor lending has continued to grow strongly since the reforms, reaching around $59 billion for the year to March 2026, rather than shrinking as predicted. Now that was before the budget, of course. Long-term tenancies went up, not down. So the doomsday scenario didn't arrive, at least not yet. And rent caps aren't even the biggest signal. Because in the 2026-2027 federal budget, something genuinely historic happened. We should know of it by now. The government announced a major overhaul of negative gearing and capital gains tax. From July 2027, negative gearing gets restricted to newly built properties only. The 50% capital gains tax discount is being replaced. Self-managed super funds are being banned from borrowing to buy residential property. Now, whatever you think of these policies, understand what they represent. For 40 years, touching negative gearing was considered political suicide. The fact that it's even being proposed tells you the political class has finally recognized the situation as a full-blown emergency. Of course they do, at the top of the 18-year real estate cycle. And here's the balanced truth you won't hear from either side. Rent caps might protect some tenants today, but if they're badly designed, they can choke off new supply we desperately need tomorrow. And it'll probably increase rents because people are scared to keep the rents at the lower rates. Renters now need relief now, but the only real cure is more homes. Actually, it's making more empty homes available, and we can see this from the water rates data. No water being used generally equals empty homes. Now, there are exceptions, but we'll leave that for future videos. So that brings us back to the heart of all of this. The dream simply changed owners. Let me tie the threads together because this is the part that matters the most. The property dream still exists. The system still works for existing owners, those who inherit, buyers with family help, and anyone who got in before the latest price surge. But for the renter starting from zero with no family safety net, the dream has mutated into something almost unrecognizable. And here's the cruel irony I promised you from the start. Prices are falling right now. In June 2026, national home values dropped 0.4%. That's the biggest monthly fall since 2022. And prices are down nationally for 3 straight months. That's the longest decline since the drop of 2022. Sydney fell 1.2% in a single month. The median Sydney house is around $1.8 million, having eased in recent months amid the broader market correction. Melbourne's forecast to potentially drop below $1 million. So surely if prices are falling, buying is getting easier. Not quite. And this is the whole thesis in one line. First home buyer loan applications fell 20% in a single year because while prices dipped a little, interest rates, deposit saving times and mortgage costs rose faster. Sydney price to income ratio has climbed roughly 13 to 14 times median income, among the highest in the world. Sydney is now the world's second least affordable city, behind only Hong Kong. If Sydney's median house had simply tracked inflation since 1996, it would cost around $465,000 today. That's pretty crazy. Instead, it costs nearly $1.8 million. Homes have become so valuable that reaching them now requires inheritance, family help, or a level of financial stress previous generations never had to accept. The trap is closing, locking an entire generation out of the market. But we don't want that. So what does the new ladder actually look like? The detached house, the classic quarter-acre dream, becomes the exception, not the rule. Separate houses have already slipped from 74% of dwellings in 2011 to 70% in 2021. And in the big cities, the shift is far sharper. In Sydney, the apartment share of homes jumped from 10% to nearly 17% in a decade. Units become the default first rung. Renters delay having kids because you can't plan for a family around a 12-month lease and a 1% vacancy rate. Regional towns become pressure valves for people priced out of the cities. Inheritance shifts from a windfall to a necessary strategy. We don't want it to get that far yet, but policies stop trying to build a ladder and they start trying to manage the fallout. None of this means apartment living is bad. People are being forced to trade down, move further out, and wait longer due to sheer mathematical reality rather than personal preference. Australia was built around one specific dream. The house, the yard, the security, and that dream is now being rationed. So let me leave you with this real conclusion, the one the headlines keep missing. The end of Australia's property dream does not mean every house crashes tomorrow. It means the promise itself has changed. For older owners, property is still the wealth machine it always was. For younger renters starting from zero, buying a property is becoming that little bit more difficult. Unless 5 things start moving in the same direction at once, income, supplies, rents, migration settings, and credit, the next generation will not experience property the way their parents did. And I don't think that's a bad thing. Their parents experienced it as a ladder. They will experience it as a wall, but a wall they can climb over. So this generation either chooses to invest the old way, like their parents, or they can find a new way, like rent vesting, or moving to a new city to start a life. This is what happened through the 20th century as families were displaced from 2 world wars. So tell me in the comment section, are you wanting things to go back to the old days of buying a home like your parents, or are you willing to find new alternatives like rent vesting, which is basically renting where you can afford, renting where you want to live and investing where it makes sense for you financially? Or maybe you're looking for a sea change away from family and friends. This is what people have done throughout centuries to find better opportunities elsewhere. People are moving overseas now to Greece, to Italy, to Southeast Asia to find cheaper properties and build a different lifestyle. There is the possibility out there. It just means we have to do things differently to last time. Let me know what you think. I'll be reading all of your comments as this topic is critical and there really isn't a right answer. Follow my charts and analysis channel for stocks, commodities, and Bitcoin. There's a link to that in the video description. That's Jason Pizzino. And our free reports are out this week. Also a link in the video description. Otherwise, I'll see you guys at the next video. Thank you very much for all of your kind messages and support over the last few months here on the channel. Until the next video, take care and peace out.